Hi everyone, I'm Stan from Eagle Vision. I'm here again with David Lipschitz. David, welcome. And we're talking about construction funding. In this episode, we're going to talk about retention, so what happens with development after it's complete and the developer either can't exit some of the stock or decides to retain some of the units. So, David, what options, I guess, do developers have at that point in time?
Well, I think this is a good question, and a lot of developers look at developments as just short term and sell and move. I think some of the more savvy developers, they're particularly those that are looking to build wealth rather than just focus on just generating quick income, often would look to retain some sites, and there's a number of good reasons to do it, apart from, being able to, there are some good tax effective strategies to do it, but also, from a GST perspective, obviously if you retain it, you're not having to pay back the GST on that, and if you can keep it for more than 5 years. Not that I'm giving tax advice, but the point is, there are ways, and it's good to talk to your accountant and talk to the other specialists early on to make sure that you're doing that right? So I'm saying there's good reasons to do it. But certainly there are some clients where they get to the end and they're just not able to sell as many as they expected. So we talked before about even if you're with a major and you have had to meet all the majors requirements and you've pre-sold 50%, and you say, well, the other 50% is going to be peachy. Well, often, guess what? You sold the best 50% early on, right? Sure. That's just the fact, right? You might hold off some of the penthouses or whatever the case may be, but often you're selling some of the good ones early because clients want to go in there and get a bargain, and they want to get the good ones. And you think, well, these other ones will sell themselves when you get to the end. Maybe they don't. So what do you do? Well, there's a number of options. Option one is if it's a smaller development, often there's ways to try and refinance it as just some residential. And again, there would have to be under three lots. But let's say it's an apartment building, and let's suppose there's a whole host of them. There's a number of funders. I know Macquarie do a lot of this, and there's others, and I know Bendigo and a few others do this, where they provide what's called a residual stock funding. And essentially, they will fund the residual stock basically based on the rent that you're going to be able to get for those. That makes sense?
Okay.
So it is something to bear in mind that when you actually are going to a funder during the construction phase, often you can't actually use the rent for servicing because they go, well, you're going to sell them, right? So we say, well, but if we can't sell them, we'll rent, then we're not even going to look at that. But now they can look at it, and you can basically
residual stock.
Correct. So as soon as it's finished, you shift it over to residual stock. Now, there's some residual stock funders that want you to keep them for at least a couple of years because they want to know that the loan's going to be there for a period. There's other residual stock funders that say, well, actually, we're fine for you to reduce that stock holdings as you go. You know what I mean? And then obviously it means that you can, from a GST perspective, it might be useful, but it also means that you can wait for the time you're choosing to be able to sell them for the right time.
And does that work for developers that are doing rent-to-build models? Build to rent?
Build to rent? Yeah, I guess so. I mean, I think, you certainly see developers out there that are building, for example, a whole host of these service apartments, for example, where they would furnish them up and all that sort of thing. It makes sense, but often that's a little bit different because the lenders won't look at it as a residual stock. They will look at it as a commercial venture.
As
a commercial venture, right? So they'll say, okay, well, how are you going to be able to do this going forward, right? And what's the income? Now, the issue then is, if they haven't traded yet, they don't own any other, service departments and so forth, then often they need to demonstrate from their own cash flow currently.
Some kind of history.
Correct. Or they might just need to go with an interim funder, demonstrate that they've actually got some consistent income, and then go to someone a little cheaper, if that makes sense. And money's cheap at the moment, but if you're going with some of the second tier or private funders, it can be more expensive.
Okay. And is there a particular criteria that applies to retention and residual loan?
Well, one of the big ones is the requirement for an in-one-line valuation. So what does an in-one-line valuation mean? Well, you know how, let's suppose you've got 10 apartments and they're each worth 500,000, right? You go, well, that's worth $5 million, right? And you say it's pretty simple, right? And I've sold another 10 for 500,000, so I know these 10 are worth 500,000, so it's pretty straightforward. Not really, because in one line val, they say, well, if you had to sell them all together in one line to a single purchaser, how much would that be? And invariably, it gets shaded. Instead of 5 million, now it's only worth 4 or 4.5, something like that. And then you're still only lending 65% or 60% against that 4.5. That makes sense?
Got it. So in one line val is basically the main criteria that they apply.
Certainly for residual stock funding, and particularly if you're talking about going concern value, like we're talking about the service departments and so forth, or a hotel or something along those lines, then there's different criteria as well. They'll look at, well, what would be the going concern value? Well, how much can you generate from the income and so forth,
Okay, fair enough. And how about pitfalls? Are there any pitfalls at this point of time for retention?
Yeah, I mean, I think the there's still, like I mentioned before, that the residual stock funders are going to base everything on the rent, right? There's still an assumption that you're going to be able to rent them out, right?
Yeah.
Now they still shade it, they still shade the rent down to 70% or whatever it is of the actual rent that they're expecting, But the point is, if you aren't able to rent, if you aren't able to, or with the service department, you aren't able to lease them out, or with a hotel, you aren't able to get that income, then suddenly you're stuck with, what could be a big white elephant, right? So again, back to, I guess, the conversation we had early on, which is, what considerations does a developer have for alternate exits? So let's assume. I know, for example, I've dealt with some clients where they're building these service departments, but what they do is they build them as two separate, let's say, one bedroom, but there's a little door that links them together, and they're both in the same strata. So if suddenly the service department thing doesn't work out, they just open that doorway, sell as a two-bedroom apartment, and suddenly it's separate now. It's got a different market, for what it's worth.
So there are always options.
There's options, but it's worth considering that, because it's very difficult afterwards to say, oh, well, hold on, I want to connect these, and I was thinking about, no, it's a bit late,
That's right.
Yeah.
That's right. Very good. Look, guys, David has provided a presentation about all of the areas of construction funding that you'll be able to download at the link below. Thanks so much for watching. We'll see you again.